Adjusting entries. What are adjusting entries? Adjusting entries are made in the general journal to record revenues which have been earned but not recorded and expenses that have been incurred but not recorded. Adjusted entries will affect one revenue or one expense account to affecting one asset or liability account, affecting one account on either the income statement or balance sheet. Here are just a few of the most commonly used accounts for adjusting entries. Have a look at the four main categories for adjusting entries: deferred revenue, accrued revenue, deferred expense, accrued expense. Now let's introduce Bob, the construction worker, and take a look at how Bob has used adjusting entries in his monthly accounting system for his business. At the start of the month, Bob was paid in advance for a job that he had not yet completed. On the 1st of May, he would have recorded the entry in his accounting system where he would have debited his cash account for the amount of $5,000 and credited his unearned account for the same amount. This would cause his assets and liabilities to both increase. Now let's say, finally, on the 21st, Bob finally completes the job. He would need to adjust his previous entry as the accounts will not reflect his earned revenue. He would debit unearned revenue and credit his earned revenue accounts both for $5,000, causing his liabilities to decrease and his equity to increase. Bob has just purchased 6 months of business insurance to cover his business if he is sick or injured. After paying this, Bob would record the entry by debiting prepaid insurance and crediting cash for the amount of $1,200. This would cause assets and liabilities to both increase. Now let's say 2 months has passed. He's used 2 months worth of insurance, and this would be classified as an expense. An adjustment would need to be made to reflect the expense. Bob would debit insurance expense and credit prepaid expense for $400, a total of 2 months worth of used up insurance. This decreases assets and increases equity.